Hi everyone. So on this video, I'm going to look more closely at Nassim Taleb's critique of Bitcoin and how it relates to the news in the last few days. So before looking at Taleb's argument, I'm going to look at a couple of our news stories. So first of all, Coinbase has blocked 25,000 accounts linked to Russia. And other digital platforms are coming under scrutiny to do the same thing. And if you look at this article from Nikkei Asia, the US, Japan, and the EU, amongst others, are looking to close crypto loopholes in Russia. It says Japan and its Western allies are racing to crack down on cryptocurrency transactions in Russia by trying to dodge sanctions. Now, what's interesting about this is it relates to Nassim Taleb's critique of Bitcoin quite well, in that I remember when Bitcoin first came on the scene, the proponents of Bitcoin argued that one of its good aspects would be that it was anonymous. In other words, yes, it would be used by a small percentage of people for fraudulent activity, just as fiat currency is, right? A lot of drug dealers, of course, just deal in cash. But that's 1% or whatever of the total. But they argue for the majority, or just give people a way of being anonymous in the same way that cash transactions allow people to be anonymous, but digital transactions like on your Visa or MasterCard don't. But what's clear about this whole Russia thing is that at the end of the day, once you're on a public ledger, the authorities can trace you. And it reminds me of this paper by Taleb, which we're going to look at in more detail. And I'm going to put the link below this video. But one of his critiques is, he says, the fallacy of a safe haven, which is a protection from tyrannical regimes. Because some people argue, well, what happens if your country becomes the next, I don't know, Nazi Germany or even Venezuela, where it becomes more authoritarian? And he says, and I'm going to read it here, to many paranoid anti-government individuals and others who are distrustful of institutions, Bitcoin has been marketed as a safe haven, also with an open invitation to fall for the fallacy that a volatile token in a public setting is a place for hiding your treasure. By its very nature, Bitcoin is open for all to see. The belief in one's ability to hide one asset from the government with a public blockchain easily triangulable at endpoints, and not just read by the FBI, but also by people in their living rooms, require a certain kind of financial seasoning and statistical understanding, perhaps even a lack of minimum common sense. For instance, a Wolfram research specialist was able to statistically detect and triangulate anonymous ransom payments made by Colonial Pipeline on May the 8th, 2021. And it did not take long for the FBI to restore the funds. So what's interesting is this has happened before. It is possible for people to actually target Bitcoin and other transactions on the public ledger, compared to something like cash, which is much more hard to trace. The idea that it's anonymous is simply not true. Now, you might say, well, hold on a minute, though. Most people buying into Bitcoin now are not buying into it because they are kind of paranoid anti-government people who think we're going to go into a dictatorship. That might be 10% of people at most. Now it's people looking for diversification. They think it's going to be the future and so on, which is why I would suggest anyone who's interested in Bitcoin or any cryptocurrency should really read Taleb's argument. It's called Bitcoin, Currencies, and Fragility. And his arguments are basically this. I'm not going to go through it step by step, but I'm going to look at the key arguments. First of all, he argues that Bitcoin is too volatile to be a currency. Now, that's not controversial, right? Most people, even proponents of Bitcoin, aren't saying that Bitcoin now is a currency. They're saying it's a source of value or something else, like digital gold or so on. But he argued it cannot be seen as a currency. And for that matter, Visa, Master, and many other providers, UnionPay and so on, offer cheaper, faster transactions. But beyond that, one of his arguments is, as he says here, gold and other precious metals are largely maintenance-free. They don't degrade over time, and they don't require maintenance to refresh their physical properties over time, whereas cryptocurrency require a sustained amount of interest in them. In other words, let's say if there was no media coverage of the price of gold, gold wouldn't go to zero. In fact, something like copper, how often do you see copper in the news? Very seldom is copper as an investment mentioned. When it comes to precious metals, only really gold and silver are mentioned as investments. And even then, sometimes, apart from gold, you can go months without reading anything about silver. And unless you're looking for information, obviously, if you type it into Google, copper prices or copper investments, you'll find information. But if you're just an ordinary person, you don't hear about copper or many other precious metals, aluminium and all this kind of thing. So Taleb's point is that precious metals, they might not be the best investment in the world. Gold and silver haven't done that well historically. They've usually matched inflation, but they don't require a lot of media exposure. And beyond that, they don't require people to maintain the whole system. Because if you think about it, gold and silver is used for jewelry. Whereas in comparison, when it comes to crypto, you do have to have people who are always maintaining the actual system, like the ledger and so on. He goes into it in more detail, obviously, in this particular article. Also, a point he makes here is this, and this is a very interesting point. If any non-dividend yield asset has even the tiniest constant probability of hitting an absorbing barrier, causing its value to become zero, then its present value must be zero. In other words, if you've got an asset producing a dividend coupon or yield, like, for example, stocks usually produce a dividend, government bonds might not pay much anymore, but they produce a slight dividend, real estate does. But if you've got a non-dividend yielding asset, even if the chance of it, hitting an absorbing barrier is like 0.1%, then its present value has to be zero. Okay. And he goes on here, to kind of deal with this point. He says, path dependency is a problem. We cannot expect a book entry on a ledger that requires active maintenance by interested and incentivized people to keep its physical presence, a condition for monetary value for any period of time. And of course, we are not sure of the interest mindsets and preferences of future generations. Once Bitcoin drops below a certain threshold, it may hit an absorbing barrier and stay at zero. Gold, on the other hand, is not path dependent in its physical properties. As discussed, technologies tend to be supplemented by other technologies, over 99%, whereas items such as gold and silver have proved resilient to existence. So what's interesting about this is I've actually spoken to several people who are proponents of Bitcoin and digital technology. And when I ask them, well, do you think Bitcoin will be around in 100 years? Many of them say, well, no, because we think a better digital technology will take over. Even now, some people are saying, no, Ethereum is the future, or this is the future, or in another 10 years, there'll be something even better. So I say to them, well, why are you investing in it then? And they say, well, in the meantime, it's good. But this is the point, right, that most technology, even if you take the view that the technology of, say, Bitcoin or any of the other coins are good, eventually there's the risk of another technology taking over, whereas with gold and precious metals, that isn't the same thing. Also, another point he makes is when it came to the financial crisis of, well, it was more like a dot-com crisis of 2000. It's true to say a lot of the technology firms didn't actually produce a dividend, and most of the technology firms went to zero. The vast majority did. Amazon might not have, Apple might not have, but the majority did. But the point he's making, though, is that actually with those particular technology stocks, they were promising at least a dividend. But in the case of Bitcoin, the promise of a dividend isn't even there. And that's what he makes a point here. He says the difference between the current Bitcoin bubble and the past one, such as a dot-com episode spanning 1990,000, is that shell companies were at least promising some kind of future revenue stream. Bitcoin, doesn't do that, basically. And also, one interesting point he makes as a final point towards the end of the article is he makes the point that when he's actually challenged Bitcoin proponents on all these points, they haven't actually kind of denied what he's saying. In other words, when it comes to path dependence or all those things, there hasn't been a sufficient critique of this. Like, I've actually looked online at people who are clearly Bitcoin advocates, and I've actually typed into Google critiques of Nassim Taleb's work, and I haven't yet found anyone who intellectually has shown a good critique of this. And when I speak to people who are interested in Bitcoin, it seems the main reason, though, they are interested is basically just because the price has gone up, which is irrelevant to Taleb's argument. So I would say anyone who's interested in diversifying into Bitcoin or cryptocurrencies, they should very much look at what's happening in the world at the moment with Coinbase, but they should also look at Taleb's paper because it's a really intellectual argument about why long-term he thinks there's a decent chance Bitcoin could go to zero. And one of the many risks of Bitcoin going to zero is if a better, so-called better digital technology is discovered. Because Bitcoin doesn't pay a yield, a dividend, or a coupon, it's only worth what somebody else will pay for it, and people are less likely to pay as much for it if in the future something comes along which is actually better than Bitcoin. So it's a very interesting paper that he's written. And I think what's happening at the moment with Russia and Ukraine is really proving right one of his points, that basically Bitcoin and cryptocurrency is many things, but the idea that it's a safe haven against either falling stock markets, which it wasn't during the fall in the stock market of 2020, or tyrannical governments, simply is not the case at all.